This video is about how government money printing took the American dream and turned it into a lifelong debt trap, and why Bitcoin is becoming the only real way out. Welcome to the Sat Stacker Show, a Bitcoin show for people who think deeper about money. I am your host, the Sat Stacker, aka the Sat Daddy, aka Satatui, aka Sat on a Hot Tin Roof. We'll see how long I can go with the puns before I run out. Hit the subscribe button if you want to learn to stack smarter and grow your conviction in Bitcoin. Here in Fiat Clownland, most of you have probably already given up on the dream of owning your own home. If you were still thinking you're going to buy a home one day, I got pretty bad news for you, because the game you're playing has been rigged since before you were born, and you are not meant to own a home. You are meant to rent your house from a landlord or rent it from the bank for the rest of your life. And apparently, you being in debt for 30 years is actually not enough, because now the president of the United States is floating the idea of 50-year mortgages. That's what housing affordability looks like in Fiat Clown world. But of course, it has nothing to do with making housing more affordable, and everything to do with propping up the house of cards that is the Fiat Ponzi, and turning you into a Fiat debt slave along the way. And unless you figure out how to opt out of that system, you're stuck on the hamster wheel forever. So let me show you exactly how they built this trap and why Bitcoin is your way out. They're not trying to actually make homes more affordable. They just want you to stay in debt until you die. And if by some magical miracle you actually can buy the house today, if you're very lucky, maybe you'll own it when you're 85 years old. Because as we know, in Fiat land, there's no such thing as lowering prices. There's only more debt and more payments. In the Fiat system, affordability itself is the lie. When money is credit, the more you can borrow, the more everything is going to cost. And the more everything costs, the more you need to borrow. You see the endless cycle of debt slavery and wealth transfer from you to the tippy top. Technology advances and productivity increases, and somehow everything still gets more expensive. Side note, made a video on that topic that you can watch right here. But instead of homes ever getting cheaper, the debt just gets bigger and longer. And this isn't just about housing, because once you start looking at this problem, you start to see the same pattern everywhere, especially in scarce, desirable things like housing, college, healthcare, cars, etc. Because if there's one thing I want you to remember from watching this video, it's this. Anything that you can borrow newly printed money to buy it, it will always skyrocket in price. And if the government steps in to backstop or subsidize it, then it really goes nuclear. This is what happens when real money dies, but fake money just puts on its clothes before anyone notices. You don't get cheaper homes ever. You get 50-year mortgages and trillions of dollars in government interest payments. If you've ever felt like you were doing everything right, go to school, get the job, try to save, try to buy a home, start a family, but somehow, like a lot of young people today, you still feel like you're drowning or barely treading water, yeah, that's not by accident. That's a feature of the system. You were born into this system, so let's see how early it starts and how deep the rot goes. Just start off by looking at student loans. Say you're 17 or 18 years old, and the first hit comes when you might want to go to college. The message was, if you want to get a good job, you got to go to college, right? So you start looking at tuition. You think you can afford it? Absolutely no chance, because tuition is up over 1,200% since 1980. And have wages kept up? Of course not even close. So what do you need to do? You borrow the money, of course, for college, but student loans are not funded by anyone's savings. They're just conjured out of thin air by banks and federal loan programs. You ever stop to think, why on earth can an 18-year-old kid with no job, no income, and no credit history borrow tens of thousands or hundreds of thousands of dollars for college when they couldn't borrow that type of money in any other scenario? You think it's because 18-year-olds are notoriously good investment prospects? I don't think so. It's because the government guarantees the loan, either directly or by backstopping private lenders. But either way, it means the risk for the lender disappears, and the student themselves is the collateral. Government prints the money, banks issue the debt, and the kid is stuck with the lifelong bill they can't discharge even in bankruptcy. No bank would ever lend that kind of money to a teenager unless they knew they'd get paid no matter what. And once those student loans were federally guaranteed and bankruptcy protections were removed, everything changed because schools could effectively charge whatever they wanted, raising the price every single year because the government would always make sure money printer went burr. Think about how you'd behave if you were those universities and you knew raising prices would never hurt the demand because your customer could always borrow more to cover the cost. Or if you're a bank and you knew you could always lend more with virtually no risk of default. So of course, college tuition skyrocketed. The easy credit that was supposed to make education accessible really just inflated the cost. And does that process sound familiar at all? Oh, we're making it more affordable by letting people borrow even more money to pay for it. We're making it more accessible to everyone by de-risking it for the lender, ensuring that infinite amounts of money will always be there to bail out bad loans. What could possibly go wrong? This is not financial inclusion. It's predatory fiat at its finest, the kind that walks an entire generation right into a trap. Okay, fast forward. I haven't even got to the housing yet, but fast forward a few years. You're 22 years old. You're tens or hundreds of thousands of dollars in debt. And if there weren't any finance courses in your liberal arts degree, you might really be screwed because you might not even be aware that paying the minimum payment on your student loan probably doesn't even cover the interest. And you could end up owing more money than you borrowed even after making payments for a decade. That actually happens to people, okay? But putting that aside, let's say AI and robotics haven't taken all the jobs yet, and so you actually land a job to service your debt. Well, you better hope that job comes with health insurance because private healthcare is insanely expensive and completely unaffordable. Medical costs, as we know, have skyrocketed. Some statistics say over 3,000% since the 60s. Well, why? Well, obviously, healthcare is insanely complex and convoluted, but the same game is still at play. Healthcare is both scarce and desirable, but it's also subsidized by government programs. Whether it be Medicare, Medicaid, what do you think happens next? Prices explode. Doctors and hospitals don't bother competing on price. They just build a system, and somehow there's always magically more money available to pay for it. But let's say you managed to survive that part. You might still need to get to your job or get around town, right? Cool. So you're probably wanting to buy a car. If this were the 90s, a new car was maybe 15 grand. But today, it's more than 3 times that. On average, $49,000. But hey, once again, no worries, because you can just finance that bad boy over 72 months or 84 months if you're lucky, because that's what affordability means in this fiat system. Always stretch the payments, borrow more money, never reduce the price. And finally, we come to the big one, because at some point, maybe you thought you had a chance at owning your home, at the American dream. I don't know whether you're American or not. If you're in Canada, you definitely still got the same problem. Australia, England, you guys got the problem too. Except median home prices today in the US, according to Redfin in 2025, it was over $460,000. In many states, it's even higher, much higher in some states. And there are, of course, no states in which the median wages or salary has kept pace with that rise since the days when your parents were house hunting. But again, it's okay. Your friendly neighborhood bank is here to save the day. They say you can leverage any money you do have saved by 5x or maybe even 10x. But if you do 10x, you'll have to pay extra for mortgage insurance, but never mind. But there you go. Say you want to buy a $500,000 home and you can bring $100,000 to the table. The bank will happily give you the rest. It's like a magic trick, to be honest. They pull the rabbit out of the hat and the rabbit just so happens to have 400 grand in its mouth. And why are the banks always able to do this? Well, it's of course because when they issue the mortgage, they create the money out of thin air. They don't lend you their money. They don't lend you other people's savings. They just create new money and lend it to you with interest, of course. But isn't that awesome? Because you can afford so much more house when you're not buying with your own money. You're buying with leverage. But so is the other guy bidding against you, which means prices go vertical. And round this system goes. Debt to get the degree, debt to get the job, debt to stay alive, debt to drive to work, debt to have a place to sleep. So you might be saying, well, this all sounds pretty broken. So the question is, if the cycle is so clearly broken, how come nobody bothers to step in to fix it? Well, you made a fundamental error because the system is not actually broken. The system is working perfectly if you sit on the other side of the equation. It's just rigged against you. And this little scam, it often starts with those 5 words that should instantly make you suspicious. We're making it more affordable. Anytime government says that, hold on to your wallet because they don't ever make things cheaper. They make it easier to access more credit. And those two things are not the same. And that doesn't lower prices. It sends them to the moon. If they backstop student loans, tuition's going to explode. If they pour trillions into Medicare and Medicaid, medical costs skyrocket. And if they roll out FHA loans, Fannie and Freddie, 0% down mortgage programs, home prices go vertical. If you wonder why this keeps happening, it's because in a fiat system, credit is money. Credit creation is money creation. And if you can borrow against something, that becomes collateral for even more credit. But that system is not creating more value. It's creating paper claims on things of value. And more of those claims to go around just means bidding up the price of anything that's scarce and desirable with more and more printed money. And when the government steps in to help, it guarantees that there's always a buyer, which means prices are never allowed to fall. If Uncle Sam shows up with a check, you know the price is going to adjust to meet the available money. Colleges, hospitals, car dealerships, home sellers, they'll jack up the price, but for the buyer, ignorance is bliss because they don't have to feel the pain right away because the payments can be spread over more and more years or decades. So today, at least on a monthly basis, it all feels manageable. And now it's not just that. If you can't afford your dinner or your groceries, you can just pay it off over 4 weeks with Klarna or Afterpay using buy now, pay later. What's the big deal? It's 0% interest. Yeah, okay, sure it is. Buy now, pay later is a $23 billion industry because no one's paying interest. But hey, if the 4 weeks is too short to pay it off, you can just pay off your buy now, pay later installments on your credit card. And on and on and on, the can kicked down the road once again until you zoom out and you finally realize you're working your whole life just to service debt on goods you can never actually afford. Which brings us to the main event, because if you think the 30-year mortgage created a housing bubble, wait until you see what happens when they make it 50. This is where the fiat scam hits peak clown show. Right now, like I said, median home price in the US, about $460,000, about 7.5 times the median individual income. And the solution on the table, just stretch the loan out to 50 years. That's 600 monthly payments. Because, the problem was clearly that we didn't have enough debt. Like we said before, when you take out that mortgage, you're not using your savings or someone else's savings. You're using bank-created credit, money that didn't exist the day before. The bank just literally types it into existence, loans it to you, and then charges you interest on it. So when you buy a house, you're bidding not with your income. You're bidding with 5 or 10x leverage on your income, thanks to 80 to 90% loan to value leverage. And so is everyone else that you're bidding against, which of course means prices get driven up, not by real demand, but just by how much credit people can get access to. I'm not going to bore you with too much math, but let's do a simple example, okay? $500,000 house, you're going to put 20% down, which is $100K. So you're borrowing $400K from the bank. A 30-year fixed rate mortgage at 6%, your monthly payment is about $2,400 a month. Never mind that that's already pretty damn close to half the monthly take-home pay of the median household income of about $83,000. We'll just leave that to the side. But over the life of the loan, 30 years, you're going to pay about $460K in interest. So just under $1 million total all in for the house, not counting maintenance, property taxes, insurance, anything else. But what does stretching the loan to 50 years do to that math? Well, the good news is it lowers the monthly payment by about $300 a month, which sounds awesome. So $2,100 a month, which gives you a little extra wiggle room on your monthly income. Yeah, I know most of you will spend it on Uber Eats and Labubus, which we'll just ignore that part for now. Because guess how much over 600 months of payments you're going to pay in total interest over the life of the loan. In this case, it's $860,000. Quite literally, pretty close to double the interest expense on the 30-year loan. So the total cost of $1.36 million for this house over the life of the loan. Now, the real life hack here is what happens if you're a super genius who watches this YouTube channel and subscribes and likes the video, and you take the difference, that $300 a month, and you stack sats, which means you invest it in Bitcoin. But I will come back to the math on that a little bit later. For now, just know that most people will definitely not do that. And do you know a big reason why most people won't do that? Well, part of the reason is some of them are financially illiterate or irresponsible. But another big reason is it goes back to my main point of this video, which is if people can borrow more newly printed money to buy something they want, the prices will just keep going up. So in other words, in that example I used, they're probably not going to buy the same $500,000 house with the same $400,000 loan and have the $300 a month lower payment. Do you know what is almost 100% guaranteed to happen? If you've ever had a conversation with someone who is trying to loan you money, you know what's going to happen, because they're going to say, well, the budget you can afford is the $2,400 a month that we talked about before. So now instead of a $500,000 house, you can afford a $556,000 house. You have more wiggle room to bid higher if you find your dream home. And bam, that's how it happens. Now you have the same $2,400 a month monthly payment with the 50-year mortgage and a total interest expense over the life of the loan of $1 million to the bank, who printed the money out of thin air in the first place. And it may not happen tomorrow or overnight, but you can damn well bet that slowly but surely home prices will creep up to accommodate that new 11% more that you were able to borrow within your budget. Maybe you don't have 20% down. I'm sure they'll figure out a way to get creative. But maybe you understand all this and you want to be financially responsible and prudent, and you only want to take out a 30-year mortgage. Well, guess what's going to happen? Now it's almost impossible for you to compete with a buyer who does choose to take out a 50-year mortgage, because they can outbid you by 11%. And that, ladies and gentlemen, is how it's done. By fiat once again. Now, if you're the government or bank, here's what's interesting. This could seemingly become a problem because A, we're pricing out entire generations from ownership, and B, we're building a giant house of cards, pun intended. Because for many homeowners, their house isn't just a place to live. It's basically their retirement account. For a lot of them, it's 50 to 70% of their net worth. Baby boomers own about $19 trillion worth of real estate, and baby boomers vote. So if home prices crash, well, you don't really have to look much farther back than 2008 to see it's a bloodbath. That's retirement portfolios, that's your voter base, and that's elections lost. And the banks, of course, don't want you defaulting on the loan, so everyone is incentivized to do one thing, which is build more housing, solve the housing crisis, and make housing more affordable. Wait, no, that's definitely not it. My bad. It's the exact opposite. Prop up housing prices at all costs. Definitely do not solve the housing crisis or build more supply. And yes, I understand there's zoning laws, NIMBYs, affordable housing. It's very, very complicated. But zoom out, show me the incentives, and I'll show you the outcome. Because for tens of millions of people, housing is their savings account. It's their retirement plan. For banks, developers, investors, mortgage insurers, they all rely on prices going up. We've turned what should be a basic utility, which is shelter, into a speculative asset and a store of value. And we've done that all because fiat money is broken. You can't store your value in dollars because they decay. So people store their value in homes. They pour their net worth into real estate, and then they protect it at all costs. Zoning, tax laws, building restrictions, all of it geared to prevent new supply. Because heaven forbid, new supply mean lower prices. And as we saw in 2008, the whole system is built on the assumption that housing does not fall. Prices dipped and the entire global financial system almost collapsed. So now the Fed literally prints money to buy mortgage-backed securities to keep the loans flowing and the prices propped up. That is nothing even close to a free market. It's just an entirely rigged one. And they need to, once again, pull the old magic trick of telling you they're going to make it more affordable. And the trick is always the same. Make the loans longer, offer more debt to make the payments feel manageable. First, it was 15 years, then 30 years became the norm. Now we're seeing 40-year products creep in, and now we have the president floating the idea of the 50-year mortgage, which will no doubt take things nuclear. People see that lower monthly payment and they go, oh, look at that. Now I can afford a more expensive house. So they bid higher and prices go up again and again. And pretty soon you'll need a 60-year mortgage. So when does it stop? This is clearly not affordability. It's a treadmill of debt where the finish line doesn't even exist. Stretching the loan term to 50 years is not a fix. It's just giving the addict a bigger hit because the old one can't do the trick anymore. This is where fiat economics always leads. Perpetual debt slavery masked as opportunity. But what if there was actually a way to flip this whole thing on its head? Maybe you know what you're doing. Maybe you're a SAT stacker. So what if you could avoid the 50-year mortgage trap? Get the $300 less monthly payment and use that as your ticket out of the fiat trap entirely. Now let's be clear. A 50-year mortgage is still fiat clown world at its finest. It exists because housing is so unaffordable that even 30 years of debt doesn't cut it anymore. But we'll throw in the twist, which is that if you actually understand money, if you're not thinking in fiat terms, you can turn the 50-year loan into a weapon. We talked about that $500K home that you want to buy with the $400,000 loan and the $2,400 monthly payment over 30 years. So if you buy the same home with the same loan amount, but stretch it to 50 years and save $300 a month on the payment, let's even say you start today with 0 Bitcoin, but you take that $300 a month and you put it into Bitcoin, which is the hardest money that's ever existed that can't be debased, unlike fiat. If you use Michael Saylor's base case model of 29% compound annual growth rate for Bitcoin over the next 20 years, which is lower and relatively conservative compared to Bitcoin's historical growth rate, the result is that in 2045, you could have $2.3 million worth of Bitcoin in just 20 years, not 50. Stretch that math out to 50 years and the numbers start to look insane. It is a lot of fun to play with those numbers, so I am going to do a separate video on the math and the different scenarios, bear case, bull case, base case, and what the different scenarios can look like. So stay tuned for that. But suffice it to say, if Bitcoin does anything close to what we expect it to do, you won't mind paying a little more interest to the bank because instead of the fiat system you, you're turning it around on them for once. You're stacking the hardest money ever known while the fiat system bleeds itself dry. Even if Bitcoin grows slower than that, who cares? The point is you're coming out orders of magnitude ahead because this isn't just a financial hack. It's a shift in mindset, a shift in philosophy. Fiat wants you to live your whole life in debt, working to pay off a home you'll never actually own, using a currency that bleeds value by the day. Bitcoin allows you to opt out, stack, and wait. Let fiat eat itself. Let the system inflate itself into oblivion. You don't have to play their game because while they're handing out 50-year chains, you're building generational wealth. So here's the truth. The 50-year mortgage isn't some bold new solution. Of course, it's a desperate patch on a dying system, stretching more debt and pulling the wool over your eyes so they don't have to face the consequences of how badly they've broken the money. They'll never admit that fiat is collapsing. They'll just offer you more credit. Longer loans, higher prices, rinse and repeat. But you don't have to go down with the ship because Bitcoin is the lifeboat. And if you like this video, subscribe to the channel because like I said, I'm about to drop an in-depth video on the math behind what your $300 a month in Bitcoin could look like. And you watch this video right here if you want to stack smarter and grow your conviction in Bitcoin. As always, you never forget, quit slacking and start stacking.